If you want to invest in commodities and you believe in the commodity supercycle and you really like money and you love high dividend yields and you prefer stocks that have an unusually low risk profile, you have come to the right place. Boy, do I have a stock for you. Let's get into it. Bull Market Lifestyle presents hot dividend winners for max dividend profits through high yields and high stock upside. Greetings from Florida. My name is Daniel Helmy. The Rule Symposium wrapped up yesterday. We'll talk more about it next week, but one of the best companies I saw at the Rule Symposium is a company I was already invested in. Isn't that great? It's no coincidence that this company named Amerigo Resources was part of the Rule Symposium and that none other than Rick Rule is invested in this company himself, because you're going to be amazed about the story you're going to hear today. But let's start with copper. If you follow this channel, you know I'm a big copper bull. If we look at a chart of copper, it is one of the best looking charts you're going to find, period, in the market, especially in the commodity market. I mean, look at this. We're zooming back. 2020 uptrend, perfect. Just made a new all-time high pretty much in May and in June. If you just say, wait a minute, yo, sauerkraut guy, did you just say new all-time high? Yes, I did. This is how good the copper chart looks. We all know what the chart looks like of oil. Ouch. We all know what the chart looks like of gold, of silver, of platinum, uranium. Well, copper chart looks outstanding. We are about 6% of the all-time highs. Yeah, that's what gold investors like me can only dream of when it comes to the metal of the kings. But copper, because of the dramatically increasing supply deficit in the coming years that cannot be solved except for higher copper prices, looks great. So copper investments are my number one interest in the critical metal space. At the Rule Symposium, nickel was really popular. Nickel is fine in my opinion. It does not have the supply-demand structure that copper offers with the incredible, dramatically growing supply deficit. And this is where Amerigo comes in. This is a copper company, but it is an unusual copper company. And that is why it is flying under the radar, even among commodity investors. This is a very unique story I'm going to tell you right now, but bear with me because you're going to love what you're going to hear today. So, Amerigo is not a classical mining company. They don't explore copper projects, they don't develop copper projects, they don't operate a mine. They are a recycling company. So they recycle waste from a gigantic underground copper mine called El Tiente, ooh la la, look at my Spanish, which is the largest underground copper mine in the world and one of the largest copper mines in Chile, run by Codelco, which is a huge, huge copper giant. If you're not that deeply into the commodity space or you're just starting out, then let me explain to you what Amerigo is doing. So when you mine a commodity project, and then you bring the ore to the mill, and you run it through the mill to get whatever you want, in this case copper, your recovery rate of all the copper that is in all the ore is never going to be 100%. It's usually somewhere between 80 to low 90s%. If it's below 80, that's not that great. If it's like 92, sometimes 95, rarely higher, that's outstanding. It's never 100. So what the big companies do is, for them, it's just not efficient to try to squeeze out the very last 5%, 8%, maybe 10% of the ore that is in, of the commodity that's in the ore, so they just throw the waste out. And this is where recycling specialists like Amerigo come in. They make deals with companies like Codelco to, again, recycle that waste to get a large percentage of that remaining 5%, 8%, 10% of the copper that's in the waste out of the waste. And that's exactly what Americo is doing. So 75% of the waste that they recycle is new waste that comes from new production from the El Tiente mine, and then 25% is historical stock waste, so old waste that's still on the property. And that old stockpile is so big that if the mine would stop tomorrow, which it doesn't, but if it would stop tomorrow, then Amerigo could easily still recycle another 8 to 12 years just from the historic stockpile. So right there, that tells you and shows you how low risk this business is, because Amerigo is not operating a mine. You don't have any of the mining risk with this company. It's a super stable business because El Tiente has been in production forever. So the waste is coming out because the amount of ore that this mine produces has been big, but it's not growing, right? But it's pretty much the same amount. And again, if there are any fluctuations within the amount of waste, then Americo can just go and substitute that deficiency with a historical stockpile. They have long-term contracts with Codelco that guarantees them that they're going to get the waste, that there are no competitors, and Codelco can't get out of it. So that is a super interesting niche business in the mining sector that not many people talk about, but it's quite lucrative. Americo is not new to this. They have been in business since 1992, and they've produced over 1 million pounds of copper through this waste recycling. I talked to them at the Rural Symposium, and as a full disclosure, I'm a shareholder, have been a shareholder for a while. I think it's been a triple for me or something, or a double. But that's not why I'm in this stock, and we're going to talk about this in a second. I'm in this for the dividend. Oh, I love this dividend. I really like this management. This management knows exactly what they are and what they're not. They're a recycling company. They are not a mining company. They don't want to be a mining company. They're in the copper business. They don't want to be in any other commodities. So the problem with Amerigo is there is really no growth, spectacular growth, that is, in the recycling part, because the volume is steady. There's not much increase in the volume of waste that they can recycle. Now, they profit 100% from rising copper prices. And there's also what I like to call the Apple effect. We're going to get to that in a second. But really, there's not, like, let's say, like a junior producer that produces 500,000 pounds of copper this year, and then next year the production is going to go to 600,000 pounds of copper, right? And the next year after, it's going to go to 750,000. Like, this growth on the volume that the junior producers have, America does not have that. So the upside here is limited. If you're looking for a spectacular multi-bagger but high risk upside stock, this stock is not for you. This is a low risk, medium upside, but super high dividend play. So because the upside is limited, but this business is so stable and is basically a cash flow machine, and the shareholders absolutely love this stock, and let me switch and show you what the stock chart looks like. And as you can see, it looks even better than the copper price. Remember I told you copper price is about 6% under the all-time highs? Yeah, Amerigo is about 5%, 5.5%. So it's outperforming copper. I mean, this is a dream chart here. If we just look at the last year, great. Above the 200, uptrends, above the 50. We talked about it in previous videos when we talked about the gold miners and the silver miners. And if you missed those videos, hit the subscribe button so you're ahead of the market. That's very rare, a chart like this. And we're going to get back to the chart in order to figure out where could we get in if we want to get in on this story. So the management is doing something that is very unique for the mining sector. And they can only do this because this business is not very capital intensive and it's super stable. Usually what happens with the mining companies is, even once they get into production and they get positive cash flow going, they use this cash flow for expansion of the mine, buying new projects, right? They redeploy this money. Well, Americo doesn't need to do that. The business is running, there's no growth. Yes, they told me at the Rules Symposium that the management would be interested in a similar type of deal for another copper mine, but they don't have anything in the pipeline right now that is of interest to them. So that could come in the future, but I wouldn't bet on it. So they decided, well, we're printing money here, especially with copper going up, and it's probably going to go higher. So they started this years ago already, decided we're going to return value to shareholders in a way that very, very few commodity companies, especially in the metal sector. In the energy sector, especially oil, it's a little different. But in the metal sector, this is extremely unique what Americo is doing, and this is what makes this company so great. So they have something that they call CRS, which is Capital Return Strategy, and it basically means that they're going to return the value and the money to the shareholders. They have two strategies that they are using, and we're going to talk about them now. Okay, so here's the deck of Amerigo Resources. That's the one that they used at the Rules Symposium as well, so it's the current one. They call themselves the Copper Factory. Well, they should call themselves the Dividend Factory. That would be more in line, or the Shareholder Value Factory. And the two strategies that the management uses are share buybacks and paying out dividends like there's no tomorrow. And boy, if you know me, you know I love me my dividend payouts. But let's start with a share buyback. That is what I called earlier the Apple effect. So they are buying back shares pretty aggressively. They have reduced the share count by about 10% in the past 6 years. And they keep buying back shares. Now, if you're familiar with the Mag 7s, the passive investment ETF strategies that have been super popular, and the Apple stock, then you know this has been one of the secrets of Apple. Apple, for over a decade really, does not have much top-line growth. Top-line meaning revenue. They're printing money, but the revenue growth is not really there. So what did Apple management do? Pretty clever. They used a lot of the money to buy back shares. By reducing the outstanding shares that were available, the growth of the earnings growth per share looks a lot more dynamic because the profit is rising, but there are less shares, so the profit per share is rising. Now, it's a Wall Street trick because if you look at the absolute amount of profit, right, that is not growing as dramatically as the earnings per share because, well, the total amount of profit is the total amount of profit. You don't have the additional benefit of the reduced share count. But that doesn't matter because Wall Street is going to do the Fugazi thing, right? They're like, ooh, look over here. Profit, earnings per share, how dynamic Apple is growing. And the retail investors say, ooh, this is great. I'm going to jump on this. And Apple being a heavyweight in the ETFs, well, all the ETFs, all the institutional investors that follow S&P and that follow the NASDAQ had to buy the Apple shares, but there were less and less shares outstanding. So that pushed up the share price. Americo is doing the same thing. Now, Americo is not nearly as big. It's like $1 billion company about as Apple, obviously, but it's kind of the same strategy. So we're going to see with a reduced share count, because remember what I told you earlier, there's not much top-line growth in America, but it's very stable. The business is very stable, but if the amount of shares gets reduced, there's a dynamic, right? A dynamic in the earnings per share, and that could lead to Americo getting higher multiples in the market. So that could push up the stock. Though, again, if we're completely honest, that is not really the truth because the total amount of profits, well, it'll grow, but especially if copper goes up, but it won't be nearly as dynamic as the earnings per share. But what do we care? We want to make money. So if we're in the stock and the market loves this more dynamics earnings per share growth, hey, we take it, right? But where this really pays off is in the dividends. And let's look at the most important slide. Here we go. So, all right. This ugly guy is going to go up here. There we go. So, and I'm going to move this up for you. There it is. So let's start in the bottom right below my ugly face. This is what we talked about. This is the share repurchase program that they run. They have been now doing it since 2021. So they're doing it consistently. And again, as I showed you, if you look at the bar diagram down in the bottom right, you see that they reduced their share count by about 10% since they started that CRS program. That is quite impressive. But what is really the juice of the story is the left side. Amerigo pays out a great dividend. Now, as typical in the commodity business, they have a baseline dividend and then they have what's called a performance dividend. And the performance dividend is really nothing else but, well, we made some extra money, for example, because the commodity prices rose and we sold the same amount of oil, copper, silver, whatever the commodity is, but obviously we made more money because the price is up. And we're going to return that extra profit to shareholders. That's what the performance dividend is. The black bars you see on the left side, that's the base dividend. The base dividend yield right now is around 2.6%. And that's not spectacular. They pay it out quarterly. Nice, right? But they started in 2024 to pay out the performance dividend. This is the golden, or it's probably supposed to be copper color. That would make sense. So the copper color columns that you see here. Now, they just started doing this in 2024, but it's very clear that they want to do this going forward because they also did it in 2025, and they just announced for 2026, you see this super high copper bar, a monster performance dividend. And that makes sense because you know how high the copper price is. Now, if you add the performance dividend, which is not guaranteed, but likely going forward, because it very much looks like the management wants to establish this combination of the baseline dividend and the performance dividend together to gather more interest in this stock. So if we calculate this out for 2026, the dividend yield of Amerigo is about 7.5%. Good luck trying to find 7.5% dividend yield in the Dow or in the S&P 500 with a company with a super healthy business model and in the commodity supercycle. I save you the time, you're not going to find it. Exception, for example, what we talked about on this channel, if you saw the previous videos, emerging market oil and gas companies. And some of the Canadians have it as well when it comes to oil and gas. Now, here's where things get really interesting, because if you believe, like me, that the copper price is going to go up, but at the same time, the management is going to keep buying back shares, so the shares outstanding, the number of shares, going to get reduced even more. What does that mean? There's going to be likely in the coming years, not guaranteed, but likely, if copper keeps going up, a higher amount of money paid out as dividend, but there are going to be less shares outstanding, which means the dividend per share is going to increase dramatically, much higher than just purely if we had the higher copper prices increasing the profits. Therefore, they're going to give out and pay out a bigger amount of money as a dividend, but it's still the same amount of shares, or even worse, it would be more shares. No, it's going to be the opposite. It's going to be less shares. That means more dividend, more money. Money! That was pretty terrible, I admit. More money per share. Fantastic for us as shareholders. I believe that in the coming years, medium to long term, if copper goes up, we're going to have a dividend yield that's easily going to be 10% on the invested capital, on today's invested capital. And that is really attractive. Now, what about the stock? Well, if the copper price keeps going up and the market catches on and they like the earnings per share dynamic and they give it a higher multiple, I can see about a double in the share price long term, right? Not in the next 2 years or anything like that. Anything is possible because this company is just becoming more and more well known in the markets. And obviously, once they reach the size where institutions can start to buy it, the institution's going to absolutely love this model because it is so low risk and you're going to get a great high dividend and you're in the copper market. I mean, this is the dream for every money manager and family office. So a double doesn't sound spectacular. I get it. But man, in addition, we're going to collect this juicy dividend every year, which is going to give us extra performance on top of the double. And we get all this with extremely low risk, no mining risk. And as a bonus, And if you followed my well, they're not recommendations because I'm not your financial advisor, but the companies that I've presented here in the past, and you know I love myself a situation where we have a joker that we're going to get on top. So, meaning we're going to have a scenario, is a part of the story that if it doesn't happen, it doesn't change a thing on the investment thesis and the possible upside. But if the joker hits, that's going to change everything, and our upside is going to go even higher. For example, Equinox Gold, when I talked about Equinox Gold, they have the Los Filos super project in Mexico, which right now is basically valued at zero by the market because they have some problems with the locals there. But if that gets resolved, all of a sudden the market has to re-rate this project, which is a great project. Huge project. So I have this joker with Equinox Gold. If Los Filos, if they can't resolve the situation there and nothing happens, doesn't change the investment thesis because it's valued with $0 by the market right now anyway. But if it gets resolved, I get that on top. And I have that with Amerigo as well, which is maybe they find a new copper project and do the same recycling deal that I've been doing here at El Tiente. So this is the combination that I absolutely love. This is an outstanding dividend story if you want to be in copper. If you are more of a risk-taking, more speculative type of investor, this could be a really good combination with some more riskier exploration stocks, where this stock gives you the conservative foundation, right? And then you can go a little crazy on the speculative side with the exploration stocks, and you reduce your risk through the dividend income that you have. And again, full disclosure before we get into the chart, now we're going to wrap it up. I already stole 30 minutes of your lifetime. I'm so sorry. I am a shareholder, and man, if I ever get the chance to buy this stock in any short-term dip, I would love to double my position. That's the honest truth. So let's look at the stock real quick. And we're going to start with moving my picture back down here. There we go. And let's flip over to the chart. Okay, so here's the chart. And obviously, if you're not invested, you're going to look at it and you're going to cry in the fetal position. Understandable. I mean, what a great chart. New all-time highs. Outstanding. We have clearly, it's going to run into the top of a triangle formation. If it breaks out, we're going to get the next leg up. Now, where could we get in? Well, the 50-day, and we have a gap fill right here. So somewhere around 655-ish. If you want to get in on a smaller pullback, that is possible. The other option is you wait if we retest the uptrend like we did here towards the end of June. So that would be probably somewhere in the 621 range. But I am invested already. Like, again, I really want more, but it's easy for me to say, if you already have a position. But this is, and let's talk strategy here for a second, one of the reasons why you at least want to have a startup position in a stock, so you're not left out in the cold. So what I can see if we get a bigger correction would be that we would get down to this area right here where we have a gap fill. I'm gonna mark this with a typical pink gap fill. And as you can see, we have the 200-day moving up. So this would be a double support that would probably be the end of it. And I can only see this happening if we get an overall heavier correction in the stock market or some wild Trump announcement that's going to shake out the market really quick, like we did in April 2025 with the tariff chaos. just because the dividend yield is so high that people gonna start buying up the stock. Just like I'm not even talking about the mainstream. The mainstream doesn't even know this story yet. I'm talking about clowns like me that know what this story really is. And well, now you know it as well. And they're going to see, oh, wow, look at the dividend yield I'm going to get. It's already 7.5%. Well, if I get it at around 535-ish, right? Well, it's even more attractive, especially going forward. So those would be the zones, depending on how you want to play this. If you say, well, if I get it at this double support of the 200 and the gap fill, and that's my Christmas present, great. If you want to get in earlier, which completely reasonable, again, dividend yield still fantastic at these levels, then it's probably either at the uptrend, the medium-term uptrend that started last fall, this one right here, or the gap fill around the 50-day. So that is it for today. I wish you a fantastic weekend. We see us on Monday. Bye-bye.